Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. So today we are very excited to be back here to do this webinar for you. And this session is all about exchange traded bonds and sukuk. Okay, so the title of for this Bursa webinar is ETBS, Importance of Bonds in Building a Balanced Portfolio. Now, before we begin, right, may I ask our friends and the ladies and gentlemen here today who are online today, now, how many of you here already have bonds in your portfolio? Or you may click the raise the hand button. If you already have bonds in your portfolio, you may click raise the hand button in the as one of the Zoom function. Let me see. Okay. Still not many. Looks like only less than 5% of you have bond in your portfolio. Okay. Thank you so much for showing your hands. You may put down your hands right now. Okay. Now today, so that our market here is big, so we can tell you more about this ETBS, because still so many of you here haven't got bond in your portfolio. And today our speaker here will talk about how important is bond to build a balanced portfolio. All right. So disclaimer, as usual, whatever we share on this webinar is only for educational purpose. So in no way that we give any recommendation to buy or sell any securities presented in this webinar. So if you decide to make any investment decision, you are 100% responsible for all your investment decisions. Okay. Allow me to briefly introduce our speaker background. He's already here on the line with us. He is a financial blogger at Bear Bursa Facebook page. He is a certified financial planner from Financial Planning Association of Malaysia. He is a former research analyst and a premier banking investment consultant. He also obtains a capital market services representative license holder for the financial planning with expanded scope to advising on equities, debentures, or warrant listed on Bursa Malaysia. So he's none other than Anson Tan. Okay,
Hello.
Anson, welcome to our Bursa webinar.
Hello, everyone. Hello.
Yeah,
Hello.
I'm very happy to have you here on our webinar today. So yeah, I guess we all can't wait to learn from you about exchange traded bonds and sukuk. So take it away.
Okay, I will be more than happy to actually share with you all. Okay, just let me share my screen right now. All right. Give me a second. Okay, I guess all of you can see my screen right now.
Yes, perfect.
Okay, so perfect. Okay, let's start the webinar today. Okay, so the importance of bonds in constructing a balanced portfolio. Okay, so basically the agenda today, I will actually go through with you all to let you all know what is bond, what is sukuk, and sukuk, okay, and what's the basic feature of a bond? Because I believe, as the survey that we did just now by Shane, by raising your hands, right? Okay, I can see most of you and don't actually have bonds in your portfolio. Okay, so we will actually dive deep into what is the basic features of bonds and what are the characteristics that as an investor we need to understand. Okay, when we are talking about bonds, this kind of asset classes, okay, that we want to put into our portfolio to diversify the overall portfolio risk. Okay, the third part that I will actually share with you all, how can we actually start investing into bond in Malaysia? Okay, what are the channels, what are the avenue that we can actually go and look for, okay, bond investment ideas. All right, so without further ado, let's start. Okay, the first part, what are bonds and sukuk? Okay, here, I will just give you guys an example, okay? So what is a bond? Okay, basically, we need to know and understand from the corporate perspective, okay? When the company, for example, here I'm using Tenaga Nasional as example, okay? As a listed company like Tenaga Nasional, okay? They will definitely, for most of the company, like I would say, even you are listed or unlisted, okay, you will actually have two channels for you to issue securities, okay, be it equity securities or debt securities to investor, okay. So basically, you have two channels for you to raise fund, okay. It's either you sell your shares, okay, through equity channels like you sell your shares to investor outside, so you list your shares on the exchange, or you just want to select a certain investor and sell it privately to them also can, okay? Then the other channel is, the easier channel is you get fundings from bank or you sell bonds, okay? But all these things are actually, we can classify them as issuance of debt, okay? So debt, it will contribute to your gearing ratio, how many percent of the your capital structure are actually coming from raising debts, and how many percent you will of it is actually coming from the shareholders, okay? So you have two channels for you to get funds. One is from the debt holders, the other one is from the shareholders, all right? So of course, I guess all of you know well about equity, okay? Whereby as an investor, if we are equity holder, equity shareholder of a company, we will only entitle to the dividend when the company management are declaring dividend, okay, at the top end. So if they declare dividend, then as a shareholder, we will enjoy the dividend, or the valuation of the company is actually low or is attractive, and investor outside, they would like to go to the open market in the exchange to buy the shares, then there will be a capital appreciation for shareholders to actually enjoy, okay? This will make up part of the earnings, okay, if the share price do go up, okay? So capital appreciation and dividend income will definitely form the earnings part for the equity shareholders, okay? But for debt holders, right, basically what the debt holders will get, okay, is only, in fact, most of the time, okay, theoretically, we will say is the interest of the debt that they borrow out, okay? They lend out to those to the company that need the funding to fund for their operation or any other matters, all right? So what are bonds? Okay, so basically, this flow chart, I guess, by looking at it, it will make it very very easy for us to straightforward understand what is bond. Okay, so just look at the first pointer first. Okay, so as investors, when we actually lend and invest our funds to issuers. Okay, so you issue your the issuers are the company, okay, whereby here, the company actually issue a bond. As an investor, we buy their bond. So if we invest the money to the company and the company are using our funds, the second pointer, okay, the companies are actually using the fund to fund for some projects or some developments, some construction developments. It could be anything, okay, it depends on the nature, the business nature of the company, all right? So if the project generates income, okay, so it will actually the company can actually gain from the project generating income for them, okay? So once they get the cash flow, they can actually utilize the cash flow to pay periodic interest. I would say most of the bond in the market, be it Malaysia or overseas, I would say close to 80-90% of the bond are fixed rate bond, okay? So they will actually pay a pre-agreed, okay, the predetermined or pre-agreed periodic interest to the investor. So as an investor, for example, if you are lending 10,000 out, okay, so what you get is actually the interest, the coupon payment that has been promised to be repaid by the company, okay? So at the end of the bond or at the maturity, what you will get back is definitely your principal plus the interest, which is the coupon, all right? So it's just like bank lending money to you. At this juncture, we are the lender that is lending money to companies or entities, okay? It can be government, whereby some of you may actually heard government bonds, corporate bonds. These are the differentiation. Any entity can actually issue bonds. What are sukuk? Okay, actually, if we are looking at the cash flow perspective, if we are trying to differentiate bonds and sukuk from the cash flow perspective, I can tell you that there's not much differences, okay, whereby as a company, okay, if they want to issue a sukuk, okay, the key difference is that in terms of the procedure for them to issue a sukuk, it will be a bit of different, okay. They will actually need to partially sell the ownership to a separate entity. Most of the situation, it will be a special purpose vehicle. Okay, so the ownership of the thing will of the asset will actually goes to the SPV already. So in that sense, the sukuk holders, right, the investor who want to lend the money will actually directly deal with the SPV. All right, you will directly deal with the SPV to get the partial ownership of the asset when they actually lend the money to the issuer. But on technically, there's no difference to an investor. Only on the technical specification, it may be a bit different, okay? But on the cash flow basis, why things are the same. You lend your money out, for example, you lend out 10,000 ringgit, and they promise to repay you 6% every year, okay? Semi-annually. So semi-annually, they will actually pay you 3%, 3%. 1 year is 6%, okay? So they will deliver the cash flow to you by paying as a coupon, okay? So at the end of the maturity of the bond, so for example, if this bond is a 6 years bond, then they will wait. You will have to collect your coupon, your interest for 12 times, okay, for 6 years. Okay, every year is 2 times, all right. So after that 6 years at the maturity of the bond, then you will get back your funds and the principal, the interest, everything, and the principal. Okay, so the interest you will definitely get at all the intervals. Okay, every 6 months you will get 3% interest, get it. So for 12 times plus the principal repayment at the end of the maturity. All right. Okay, so here you can actually see a picture, okay, whereby this is the authentic bond certificate that we can see in the older days. All right. So in the older days, we can actually see that a bond certificate actually come in a physical asset. Okay, so you can actually see and hold the bond certificate to prove that you are actually an investor, a lender of all these bond issuance. Okay, so and at the second part here, right, on the bottom here, you can actually see that there's a coupon, okay? So when is the time for the coupon payment, right? So for example, if you invest into this bond at January and 6 months later, by 1st of July, it's supposed to be the time that you are taking your coupon, the interest already. So what you need to do at that time is that you can tear it out, okay? That small piece of the coupon, you can actually tear it out, then go to go to the company and claim your coupon, the interest payment, okay? So this is how the bond works in the older days, I would say. So if we are looking at nowadays, how the bonds are actually, the bond market is working, all right? So basically, when you look at bonds, you can actually see the name of the bond in this way. They will actually structure it in this way. So perhaps this one, I will start with the bottom one, okay? So this Gen MY, right, is actually the bond name, okay? So which means this is the issuer of the company, okay? This is Genting Malaysia, okay? This is the bond name, Genting Malaysia. And the coupon rate, they already stated at the bond name, okay? 4.78%, okay? 4.78%, they will pay it to you every year, okay? This is the coupon that they promise to you. Every year, they will pay you 4.78% interest, okay, from Genting Malaysia, all right? And when is the maturity date of the bond, which means what's the tenor or what's the duration of this bond, this debt issuance, okay? So it will be until year 2022, okay? 31st of March, year 2022, okay? So you will know by this time, the bond will actually, you will be getting, as a bond investor, you will be getting all the capital repayment, you will be getting all the bond coupon at the interval. So at the end of this maturity, you will get back all your principal, provided that the company don't go bankrupt or default on the payment, okay? Otherwise, they will definitely pay you, all right? So at the type of the bond, you can actually see that this is a corporate bond, okay? CORP, the type of the bond is a corporate bond. And the currency we can see from here, this is a MYR Ringgit, Malaysia Ringgit bond, okay? Ringgit Malaysia, all right? So on the top, okay, on the top, we can actually see this bond is MGS. Okay, so what is MGS here? MGS actually stands for Malaysian Government Securities. Okay, so at the coupon here, they are actually for the government of Malaysia. Okay, so this MGS is a bond issuance from Malaysia government. Okay, so Malaysia government compared to Genting Malaysia, of course, the risk of bankruptcy is definitely lower. So the MGS for the government of Malaysia, they can enjoy a lower interest rate to pay to the lender, the bond, the bond investor in this case, I would say. So every year they are paying at least, I think close to 1% lesser annually, okay? And the maturity of the bond is 15th of March, year 2019. And the type of the bond, this is a government bond. This is a government bond, which is very different compared to a corporate bond. Now, government bond is definitely issued by government now. Okay, corporate bond, in terms of the risk, corporate bond, most of the time it will be definitely higher than a government bond in a standard or typical situation, unless the government, their fundamentals in terms of their debt profile is not very healthy, right? So the currency is still the same, the ringgit. Okay, so by looking at this slide, I guess you will start to understand, okay, by looking at the bond name itself, what you can know about the specification, the term about the bond that you will need to know, okay? So you will know the issuer, the company is actually Genting Malaysia, and the coupon is actually 4.78%. Annually, they will pay you 4.78%. And as the maturity date, when is the end of the duration that I can collect interest from Genting or MGS, the government of Malaysia? Okay, and what's the currency of my investment? Okay, so because Genting, they could have some of their US dollar bond also. Okay, so in that sense, the currency would be USD, all right? So let's proceed to the next slide. So by here, right, okay, we can actually, okay, here we can actually, the next one is why do corporates want to issue bonds? Okay, there are three key reasons. As an investor, we need to understand the fundamental and the concept of a bond before we actually start to invest into it. The product knowledge is very important. So we need to understand why company, they want to borrow money in this way by issuing bonds. All right, okay, there are three key reasons. The first thing is actually the cost of funding is definitely lower. Okay, this is definitely true because if we are talking about equity fundings, right, if you want to raise equity by placing out new shares, IPO or private placement, definitely your cost of funding will be high, definitely higher. Sometimes it could be up to double digit, okay, to actually issue some new equities to the market. Because for that one, we actually need to see the cost of equity, but I would say generally, the cost of funding from issuing a bond is definitely lower if your company are having a very good balance sheet, okay, a healthy fundamental. And in that case, I believe that a lot of the investors were definitely okay and willing to lend the money to this kind of companies, I would say. The second key reason it would be the interest on the bonds, okay, but here is that they are actually deductible on corporate income tax, okay. So if you are some corporate finance technical guy, okay, you should be able to understand this one on the basis is that why company need to issue bonds when they doesn't need to raise the funding. One of the key issue is that the interest of the bond is deductible on their interest, on their income tax, which means if your company are earning good money, it's okay, whereby you guys don't need to raise bond to actually fund for any projects one. With the cash in hand, you can actually fund all your project without any obstacle really. But it's just that you want to save your income tax because those money, those interest that you pay on the bond, okay, for example, if your company, the funding cost is about 5% or 6%, these 6% of the bond issuance, okay, so for example, if you borrow 100 million, so every year 6% is about 6 million. This 6 million, you can actually utilize it to deduct your income tax. So in certain sense, it can help to it can actually help to increase the company income and increase the company net profit or the bottom line, I would say, okay. So in certain sense, although you are paying a certain, you are actually paying a interest out to the lenders, okay, but at the other end, you're actually saving tax, okay, you are saving tax for your company. So ultimately, as a corporate, if you are looking at the corporate finance perspective or the aspect, right, we will definitely ask the company, as an analyst, we will always ask the company management whereby what's the expected or the preferred, okay, capital structure of the company that they want, like how many percent gearing ratio they would actually believe it will be the best structure for the company. In fact, a certain way, I would say, in fact, okay, if the company are very rich in cash, certainly it may not be a good management, the method of the management to manage the company also, because they are not fully utilizing the benefit or the advantage of their healthy balance sheet. Because if your balance sheet is very healthy, you should actually utilize the opportunity to get some of the cheap fundings from the market. Okay, it can actually help you to maximize your shareholders. You can maximize the shareholders' interest as well by saving them and improving the bottom line in a sense, all right? So the third key reason is actually the ownership interest in the corporate. It will not be diluted by adding more owners, because some of the time investors will ask this kind of question: hey, why this company, they would like to raise so many shares? Why not they just issue or place out some new shares to new shareholders? So in that sense, right, the government, the company, their gearing ratio is not that high, the debt level is not that high, so they will not be dragged or burdened by the interest burden in that sense, in the interest payment. So in that sense, they doesn't need to repay the interest and the principal of the money that they actually borrow from all the lenders or the bond investor, okay? But in that way, right, it will definitely have a huge dilution effect on your shareholding structure, whereby in the past, all these 100 million net profit are actually shared by 10 of the shareholders. But right now, because you want to raise extra equity fundings, and this profit need to share by more owners already. So the pie that you are getting as a normal shareholders, if you doesn't increase your share, right, if you doesn't increase your equity holdings, okay, your earnings in the your pie, okay, your profit pie in the company will definitely be diluted. Okay, so these are some of the reasons why company also want to issue bonds, is actually to prioritize the ownership interest of the company. Make sure their bottom line are not diluted. Okay, so the shareholding is not diluted, then the owner will get to enjoy more profit. Okay, and they can, in that sense, you can maximize your owner interest, I would say. All right, let's go to next slide. Okay, so just to let you all know, okay, how we are actually pricing bonds. Okay, so on a normal circumstances, the bond pricing, if the bond price actually move up, okay, so most of the time, for example, if we are looking at investment amount of 1,000 ringgit, okay, so if the bond price raised by 1%, okay, if the bond price raised by 1%, it will consider anything that is above 100%, I would say the bond price of above 100, it will be trading and priced at the premium. Okay, so in that sense, if the bond price is higher, when you want to buy the bond or you want to sell the bond, you can actually transact the deal at a better pricing, okay, or a higher pricing, I would say. So if the bond price drop, it will be a discount. Okay, it will be a discount. For example, if this bond 1,000, the par value is at 1,000, okay, but the bond price from 100 dropped to 99% already. So the investment amount that you need to fork out is only 990 ringgit. All right. So here we see a difference. If the bond price go up, okay, you will need to fork out more money to buy the same bond. But if the bond price go down, you will need to fork out lesser money to buy the same bond. All right, okay. So I believe until this slide, you guys should be still manage to understand what I'm trying to explain easily. Okay, so the next slide, I will actually share with you guys more about the relationship between the bond price and the yield. Okay, so you can understand the terminologies and the process flow, how we actually analyze and judge and understand more about bonds. All right. So there's two key things that we as a bond investor need to be aware. Okay, the first thing is the bond price. The second one is the bond yield. Okay, the bond yield which is the interest rate that you will be getting. Okay, the interest rate that you will be getting every year for holding this bond. All right. So why is it when the you can see like from this box, all right, when the bond price go up, the yield will go down. When the bond price go down and the yield will go up, this represent actually an inverse relationship between the bond price and the bond yield in this case. Okay, so just to let you all know better, I already prepared example here in scenario 1, scenario 2, and scenario 3 in a cash flow perspective, so that you can understand it better. Okay, so perhaps you can spend 10-15 seconds on reading and trying to figure out what is happening in the slide first. Then I will drink some water. All right. So yeah, so on the scenario 1, we will be looking at the bond on when the bond pricing is at 100%, when the pricing is at 100%. If this bond, they are giving an interest rate, okay, a coupon rate of 6%. Okay, so just to let you all know, when the bond is actually issued, okay, on the first day, okay, for example, this one, the bond is actually issued. When the bond is issued, okay, they will actually fix the coupon rate, which is the interest payment that they are promised to give. Okay, so for this coupon rate is 6%. Okay, so the par value here we are looking at the investment amount of 1,000 ringgit. Okay, so when you are investing into the bond, okay, on the first day when you are buying this bond, you are just paying 1,000 ringgit, and every year you will be getting your 6% interest. Okay, you will be getting your 6% interest. Okay, so 2018 you get 6%, 2019 you get 6%, 60 ringgit, and because the bond actually matured on year 2020. Okay, so at the end, at the maturity itself, you will be getting your principal 1,000 ringgit plus the 60 ringgit coupon. Okay, so by looking at it, your yield to maturity, the interest that we are enjoying, the return that we are enjoying every year is 6%. Okay, this first scenario, I guess, is pretty clear and pretty direct. Okay, so the gimmicks actually showed it. We will be understanding the gimmick on the scenario 2 and 3 now, right? So if the bond price actually go up by 1%, all right, if the bond price actually go up by 1%, the coupon rate is about is still the same. Okay, it's still the same. The coupon rate is still the same, 6%. What is the difference here is actually on the first date itself. Okay, when you are buying the bond that time, you will need to extra fork out 1% when you are buying the bond. You need to fork out extra 1% when you are buying the bond in this case. Okay, so the only difference is that you need to fork out extra 10 ringgit. Okay, and every year you will be getting 6%, 60 ringgit, 60 ringgit. At the end of the maturity, you will be getting back 1,060 ringgit. Why you are getting 1,060 ringgit only, not 1,010 plus another 60 ringgit? Okay, you need to understand. You need to understand in this case, whereby when the company issue the bond, the company only take 1,000 ringgit to from the investor, from the bond investor. Okay, but it's just that when the bond price raise in value, okay, when the bond price increase in value from 1,000 ringgit to 1,010 ringgit that time, right? Okay, when you are buying that bond from the previous owner in that sense, okay, you are actually forking out extra 10 ringgit, okay, because you believe that, the fundamental of the bond issuer are improving. So you don't mind to fork out extra 10 ringgit to own that bond, okay? So in the actual reality, the other cash flow will remain the same. And at the end of the maturity, the bond issuer, the company, they will only repay you 1,000 plus the 6% interest rate. Okay, so because you are forking out extra 10 ringgit here, but you are getting the same cash flow at the remaining tenor. So your yield, your return at this stage, for the second scenario, it will be lower, okay, because you are forking out extra 10 ringgit already and you are still getting the same cash flow, okay? So your yield to maturity here will be 5.6%, okay? So I guess this example are pretty straightforward. So the third scenario is that if the bond price actually go down, so if the bond price actually go down, by the time that you want to buy the bond, you will just need to pay 990 ringgit, okay? But at the end, at the maturity, you will be receiving 1,000 plus 60 ringgit, okay? So in that sense, you are forking out lesser money, but you are receiving the same par value of 1,000 ringgit. Then of course, if you are managed to buy the bond price at a discount, you will be getting a higher yield to maturity. So yield to maturity is actually the return, the holding period return that we will be getting from holding this bond. All right. So you can see if you are buying at 99% at a discounted rate, your return is the highest. If you are buying it at a premium, your return is definitely lower. But if you are buying at the middle, which is the par value, your yield, your return will be same as the coupon rate. Okay. So there's three ways okay, for us to make money from bonds investment. There's three ways for us to make money from bond investment. The core component here, it will be definitely from the coupon payment. Okay, I would say the most important one, it will definitely be the coupon payment, the interest rate that we are getting, the coupon that we are getting, the fixed or the promise coupon that we are getting from the bond issuers, the company. Okay, but if you are actually buying the bond at a discount, or I can say, for example, if you are buying at 110, but you manage to sell the bond at 112, okay, 12%, okay, 112%, you are still making a 2% capital appreciation there. It will be still possible, okay? So the second core component for us to make money on bond, it will be from the capital appreciation. The third one, it will be from forex gain now, okay? It could be a loss as well, like if you're investing into foreign currency bond. Then if these three components will add up and become your return, all right? So it will be, I guess this part is pretty straightforward as well. You can actually just see the coupon payment, okay, as some sort of a replacement for dividend, okay? If you are looking at equity shareholders' point of view, and if you are comparing a bond to equity, it could be the difference. Okay, dividend, it will, at this place, it will be replaced by a coupon payment already. All right. So the two key risks on bond investing that we will be need to definitely be aware, I would say, the two things that we need to be aware. All right, the key risk, okay? The first risk, it will be the credit risk, whereby the company or the issuer doesn't have the money to repay to the bondholders, okay? If the company, okay, meets any cash flow problem and they cannot refinance the money, okay? They cannot refinance the bond, they cannot get the funding to repay the investor in that sense, okay? They will just show you, now you see, my wallet is empty. I don't have money to pay you, okay? So in the sense, you are actually facing a default, which is coming from a credit risk. So in that sense, as a bond investor, we will definitely need to evaluate the credit profile of the bond issuers, the company, to make sure that they have the ability to make the repayment to us. Okay, it's just like banks. Okay, when they want to lend money to us, they will look at our secrets, look at our repayment pattern, look at our credit profile to know that, hey, we are actually some good kaki, okay, we are some good repayer, that we will definitely repay our money on time. Okay, so this is, of course, as a bond investor, anything that is related to that, right, it will have a credit risk component here that as a bond investor, we will need to be careful. All right. So the second risk, it would be the interest rate risk that we will definitely face when we are investing in bond investing. All right. So just to let you all know, you have to imagine a bit at this sense, okay? Like the example that I shared with you just now, okay? If the bond, you are investing 1,000 ringgit and you are getting 6% coupon, you are getting 6% coupon from the company. They promise to repay you interest rate of 6%. every year, okay? At this juncture, because our interest rate is at, if I'm not mistaken, the FD rate is about 2%, okay, slightly less than 2%, but if you manage to get some promotional rate, it would be slightly more than 2%, okay? So we are comparing 2% to a 6% coupon, okay? So for example, if Genting are issuing a bond and they want to get money from you, they are giving you 6%, perhaps you will actually consider, because at the FD rate at this moment is only giving you 2% return, okay? They are only giving you 2% risk-free rate return, okay? But here, because you are taking some extra credit risk, okay? Because there's still a risk that Genting Malaysia will go bankrupt and face bankruptcy issues, okay? So you will definitely have some credit risk imposed on the that the bond investor will be facing in that sense, okay? So in that sense, right, okay, you are willing to invest into that bond that is issued by the Genting and to happily take the 6% coupon, okay? So in that sense, FD rate 2% and the coupon are giving you 6%, okay? And the company are giving you 6%. But imagine if because as we know, COVID are actually impacting our economy very badly, I would say. But for example, if everything normalizes and economy recover, business recover back to the normal condition, environment, things normalize, all right? So if things normalize back to the previous days, the normal days already, the bank negara will definitely normalize the interest rate, the OPR rate as well, okay? So if bank negara increase back the interest rate back to, for example, 3%, okay? They increase 1.25%, 1% back to 2 point something or 3%, okay? So comparing to an FD, that time I believe you can get 3 something or at a promotional rate of 4%, all right? 4% FD rate compared to a 6% bond, which one it will be more attractive? I believe some of you will still think that 6% from Genting Malaysia is still very attractive. I will still take the Genting deal, okay? But some of the investors here, they may start to be shaky already. They'll start to be shaky because they will think, investing into this fixed deposit, perhaps I shouldn't say investing, I would say depositing our money with the bank. I'm getting a risk-free rate of about 4%. Technically, we can say it's risk-free, but of course, bank will have some, if bank face liquidity risk, there will still be a chance that bank will actually go into liquidity problem and or bankruptcy one also. Okay. But if we are comparing FD 4% to a 6% bond, okay, 6% coupon bond in this sense, some of you will have definitely switch to investing and depositing your money with the bank to get their FD rates already. So in this case, we can actually know that for you to understand the interest rate risk, whenever interest rate goes up, bond price will definitely go down. This is the inverse relationship between interest rate and the bond price. Okay, when the bond price go down, the interest rate will go up. Okay, but when the interest rate go down, the bond price will definitely go up. Okay, because the FD rate are no longer that attractive, then investor will lean on taking extra risk, extra credit risk by getting a better return, okay? Because as an investor, we always have options, okay? So we need to weigh the risk and see whether we can actually take the risk, okay? So these are the 2 key risks as a bond investor we need to be aware, all right? So if a company goes bankrupt, okay, so I believe this question, I actually heard it from many investors before. Okay, so most of the time when I introduce bonds to them or I recommend bonds to my clients, they will definitely ask me, hey, if the company goes bankrupt, what will happen now? Okay, so just to let you all know, if the company goes to bankrupt, the first thing the liquidator will do is, okay, they will try to restructure the company. If they can come up with some favorable terms with the equity holders and the bond holders, then the company may not need to liquidate everything and go to bankruptcy, okay? But if they couldn't restructure the company, okay, so in that sense, they will need to sell off everything. They will need to sell off every asset of the company and convert it into cash, okay? And convert it into cash, okay? They may need to face some haircut. For example, if this factory is worth about 100 million, but because you are liquidating your asset and the liquidator, they don't care about the value. They want to get back as much as possible as soon as possible, okay? So what they will do, they will just take a 10-20% haircut and sell your asset and convert everything into a bond within a given time frame, okay? Then the remaining money or the cash that the company still have by selling all these assets, the first person that they will actually repay is the debt holders or the bond holders. Also, of course here, the debt holder, it could be banks, then bond holders, it could be individuals or institutions. All right. Then the second player that will be getting the company monies, the asset, it will be the preference shareholder. Then the last one that get anything that is left over, it will be the equity shareholders. Okay. So in this sense, if the cash or the money is only enough to repay the bondholders, then sorry, the preference shareholder and the equity shareholder, it will not get anything. All right. So here is a table for us to actually compare what's the difference between bond and fixed deposit. Okay. So just to let you all know, chances of having a capital appreciation is definitely a yes for bond, a no for fixed deposit. And in terms of insurance, bond is not insured by anybody, okay? But for fixed deposit, it will be insured up to 250K by PIBM. In terms of liquidity, for bond, of course, like any securities or any investment securities, you will need to see whether in the market there's an offer price, there's a buyer that's willing to take your securities, then only you can sell in the market, all right? But if, for fixed deposit, the liquidity, you're definitely coming at a reduced or forfeited interest rate, okay? Because we all know the fixed deposit terms actually change. Most of the bank at this juncture, they are not giving you any interest already. If you want to withdraw your FD or liquidate your FD at an earlier time before the maturity, all right? Then the return, of course, for bond normally will definitely be higher, okay? Then for fixed deposit, normally it will be lower. The next one, okay, if we are comparing individual bonds and bond fund, okay, in terms of the certainty of the cash flow, the individual bond is very transparent, and yes, okay, they will have a certainty of cash flow, because if you are investing into this bond, you will definitely know what's the coupon that they are paying annually and things like that. So you will know all the terms and the specification already. Okay. So but as an investor of bond funds, right, you may not know when you will actually receive certain cash flow, because it will be depends on the fund manager whether they are buying and sell bond constantly, and whether they want to declare income distribution for fund investor in that sense. All right. And of course, in terms of diversification for bond fund, there will be a good level of diversification, because bond fund, they will help you to invest into 30, 50 or 100 bonds in your portfolios. But for individual bonds, no. Unless you're buying a few individual bonds, then you will start to actually lower down your portfolio risk and start to diversify your risk over. All right. So the next part, I will actually share with you where are the bonds traded in Malaysia. Okay, the first place is actually over the counter. Okay, the over the counter is what on the finance guide, the general terms we say OTC. All right, so OTC for Malaysia, you can understand it in this way. So if you are a high net worth investor, why I actually classify as a high net worth investor? Because in Malaysia, if you're a high net worth investor, the entry, okay, the minimum entry for individual bond in the market, okay, is about 2,000 and 50,000, 250K ringgit Malaysia for you to buy a one standard lot of bond, okay? So what you need to do is you engage with your bankers, RM, relationship managers, and then you just let them know you would like to subscribe or buy into any bonds, okay? So they will be the banks, right? They will have their own dealers. They will actually deal with all the players in the market, like Maybank. They will actually buy, if they have this kind of inventory, then they may actually sell it to the investor. But if Maybank, they don't have, for example, if as an investor, you want to find a bond from Kejaya Prospect Property, or you want to find a bond from Ecoworld. Okay, so if you find this kind of bond and the bank itself, they don't have this kind of inventory, they may actually get the inventory from a second dealer, from CIMB or RHB perhaps. If RHB or CIMB, they have this bond on hand, then they will sell it to the main bank. The main bank will actually sell the bond to you. Okay, so it is actually happen and occur at a customized basis. So this is what we call OTC. Okay, so everything are quite customized. Okay, this is the traditional avenue that we can actually go and buy our bonds. Okay, but it's just that the entry ticket is quite high, I would say, in this sense. And the second way whereby Bursa Malaysia actually enable the exchange listed bond, if I'm not mistaken, is about 10 years or slightly more than 10 years. I can't remember the years already, which date they actually start to launch the ETBS. Right? But the second option that you can buy bonds is over the exchange, okay? Whereby Bursa Malaysia, they will actually evaluate and list some of the bonds from the approved bond issuers like Dana Infra, okay? So they will actually list the bond on the exchange. So if you have a normal trading account, what you need to search is just go to the your trading hall by searching bonds, the category classification. You can actually filter in bonds. Then you can see all the bonds that is available on Bursa Malaysia. Okay, so in terms of the pricing, it will be determined or set, okay, by some of the market makers, the bankers, or the buyer or the seller of the individual investor that is holding the bonds. Okay, so you can actually go and buy the bonds like buying the shares normally. Okay, just hit the ask price, or you want to queue at the bid price also can. It's okay, one, right? So and the minimum size of the bond is not like the equity investment. We will need to definitely on a minimum level, one lot is 100 units. Okay, it's not the case for bond investment on Bursa Malaysia. The minimum is only 10 units. Okay, so what you need to do if you want to buy one lot which is only 10 units, you if I'm not mistaken, the bond pricing is 100 ringgit for per unit, 100 ringgit, 100 plus if it is trading at premium. So you just pay the 100, for example, 102 or 103 times the 10 unit for one lot that you are getting, 1,000 plus a bit, then you can actually more of it, then you can actually own a lot of bond by yourself already. So you can actually start investing bond with 1,000 plus ringgit in Bursa Malaysia. All right. So just to let you all know how's the selling and the buying of bonds work in Malaysia. Okay. So from buying a bond, if the bond is a new issuance, it will be some sort of similar application now. Okay, like you are subscribing for IPOs. You will perhaps, if you try to subscribe IPO before, you will need to log on. You will need to log in to your bank website, okay, and the facility there, and select eIPO and things like that to subscribe for IPO. All right. Actually, when they are going through primary market issuance on the Bursa Malaysia, they will have the similar channel for you to subscribe also, okay? Or through the secondary market, which is via the trading hall of the stock exchange, whereby it's just like similarly to buying a stock, okay? If you want to sell, it's the same. It's either you sell back to the other buyers, the new buyers that are interested in bonds, or you hold it until maturity. Okay, at the end of the tenure, then the investor, you will get back the money from the issuers in terms of the interest, the principal, everything. All right. So basically, yeah, this is how we can actually buy and sell bonds on Bursa Malaysia. All right. So some tips for you guys. If you want to buy bonds, right, you will definitely need to go through the prospectus or the info memo of the bonds. Okay, all these things, if you are buying from Bursa Malaysia listed, the exchange listed bond, you can actually go to the filing and try to find the info memo of the bonds and understand more about some of the features inside. Okay, there will be a take document that you will need to go through. All right. So the key takes away from my presentation in this webinar today, okay, the first thing it will be bonds are relatively safer if we are comparing to stocks, okay. And the second thing is that the default risk and the interest rate risk can actually be mitigated because we can actually do our fundamental analysis, our homework to know that, hey, actually the company, whether they will have issue getting back some of the cash flow to repay the bonds. Okay, so if you don't think there's any issue and the company is actually a cash cow, so you can actually mitigate this kind of risk on, okay. Then the third one, it would be the bond is a very good source of income, okay. If you are wanting, if you actually wanted to get stable and predictable cash flow, bond could be a good source of income for for investor like you, all right. So yeah, that's all for my presentation today. So we will proceed to Q&A session.
Okay, if you have any questions for Anson, please write in the Q&A box and then we address them accordingly. So thank you so much, Anson, for a very engaging session on bonds. I guess many of us here would have understood bond better, including how to calculate yield, and also we understand what is yield to maturity. Okay, and some of the correlationship between interest rate and also bond price. Edmund Chu would like to ask, how many ETBS now available on Bursa Malaysia?
If I'm not mistaken, I think it's 3. Yeah.
Actually, no.
If I'm not mistaken, it's 3.
The answer is 4.
4. Okay. Yeah.
Yeah. If I may add, it's 3 is by Dana Infra for the construction of MRT. And then the other one more is by Isan Sukut. So that was issued by Khazanah. That is I think the first socially responsible ETBS that is used to construct schools. So yeah, so that is how the ETBS are like. So they're in total 4. Interest rate, I think, is around 4% per annum range, plus minus. Okay. Yeah. Tiong Tin would like to ask, would you explain what is rating and risk? Anson, are you
okay? Rating, because still due to the duration of the webinar is not that long, so I didn't touch on the bond rating part. All right. So you can hear me, right, Shane?
Yes, can hear. Just now lose you for a bit.
Okay, right. I think the connection not too stable. Sorry. Yeah. Okay, so for the rating, actually, you can actually try to go and Google search. Okay, try and go and Google search on the. You can actually type like bond ratings from S&P, Fitch Rating, all these kind of rating agency. But it depends. Okay, I would say not all the bonds are actually rated. There will be some bonds in the market that is unrated one. So as an investor, the first thing that we need to do is we still have to do our own homework if we are dealing with rated bonds or unrated, because the rating agencies, they only do the analysis or their homework based on historical data of some past data. If the future or the prospect of the company is changing or evolving, things are not looking so good already, they may actually readjust or reevaluate the rating of the bond and adjust it lower if the prospect. We will definitely still need to do our own homework, okay?
Okay. The next question is by Chi Hian. Based on past few year performance on unit trust bond, is very low, less than 3% a year. So should we invest in unit trust bonds or other alternative?
All right. A very good question. So I'm not sure what kind of unit trust a bond fund that you are referring to. Okay, because if we are looking at the past few years whereby we are from a high interest rate environment go to a low interest rate environment, at this kind of environment, definitely bond funds will enjoy a very good capital appreciation in the process one. So I would say that okay, I would say most of the better performing or good performing bond funds, right, they should be having a better return there's yeah, better than the average coupon one. So for example, if the interest rate, the average coupon is paying you 4%, right? Plus a few percentage point on the capital appreciation, every year you should be getting a 7, 8, 9% one. Okay. So at that kind of environment, if the bond fund is not giving you that kind of return, I would say that one is a very lousy bond fund, a very lousy fund manager. You should actually look somewhere else.
Okay, thank you so much, Anson, for the tip. This question is interesting. Asked by Davy Hong. Does the bond price normally increase just before the X date of the interest payment?
Increase before the X date of the interest payment.
Yeah, I think people.
This one you are referring to bond, right? Okay. So, okay. So, certainly you need to know that. Okay, so for the normal OTC market bond, okay, actually it makes no difference. Okay, it makes no difference for you to actually, for example, just to let you know, okay, actually we will call the bond is actually having dirty price and clean price one, but that one is quite technical already. I won't touch that one, but I will just let you know, if you are buying, okay, if you are buying a bond in the secondary market, you are buying the bond from the previous owner of the bond. Okay, so for example, if the bond is supposed to pay interest by January and July. Okay, every 6 months they will pay the interest, the coupon already. All right, but in between, the previous owner want to sell the bond. Be it April. Okay, they actually want to sell the bond at April. So you will actually think, in that sense, the owner is not getting the interest payment by July already. So the owner will actually lose out the interest rate payment that he's supposed to get for that first 3 or 4 months of the investment. Okay, I would tell you, for the market maker, they will actually, if you are buying bonds from the exchange, they will actually factor in the accrued interest. Okay, the interest that the previous the previous owner should actually receive. Okay, so they will actually adjust it higher day by day. Every day, what is the supposed coupon, the accrued interest, that's the technical term that what we call, okay, the accumulated interest that the owner should receive. They will actually factor into the price already one. So as a new owner or the new buyer, in that sense, you won't be able to take advantage in that sense one. Be it you are buying it from the exchange, or you are buying it from OTC, or you are buying from the bank, it will still be the same one. You cannot take advantage in that sense one. You will still need to fork out that few percentage point of the coupon payment to the previous owner. Okay, so you will need to fork out in advance. Okay, for example, why you need to fork out in advance? Because you didn't own the bond from January until April. Okay, so you need to fork out that 4 months of coupon to the previous owner first. Then you hold from April until July. Okay, until July, these 3-4 months. Okay, these 3 months, then you will be able to get the previous 6 months all in a whole lump sum together in terms of the interest rate. Okay, so yeah, for your understanding.
Okay, yeah, thank you so much. That's very insightful. The next question asked by Zhu. Can we use technical analysis to analyze bond and sukuk?
Zhu, just to let you know, for bonds, I would say most of the time it's not meant to be for trading. It's not meant for trading. It's for conservative investors. They would like to buy and hold a bond and enjoy the income that's generated from the coupon. Then they will go for then they will definitely go for bond. Okay, in that sense, because the price volatility for bond is very, very little one. I would say if a good rating bond, the maximum drawdown or the range of the price movement of the bond price, it may be just 2-3% every year for those kind of good rated bonds. Okay, so I would say most of the bond are not meant for trading, like, unless you are buying into certain companies that are having a liquidity problems, then the bondholders are selling panically on the bond, then you may actually trade on those kind of situations. But of course, you are betting on the company whether they will be able to repay the money. If they are not be able to repay the money, then the bond price may drop further, or they may declare bankrupt, then you couldn't get any money out of your investment already. Yeah.
Okay. Shi Yi would like to ask the next question, which is, any tips on how to choose a good exchange traded bonds and sukuk on Bursa? Thanks.
I would say those
maybe Anson, maybe I share my screen for the available ETBS
right, yeah, sure.
for the benefit of our audience. So here are the 4 ETBS that are available on Bursa Malaysia. Yeah, the 3s are on issued by Dana Infra, National Berhad for MRT project, and the last one is Isan Sukuk, like I've mentioned earlier. Okay, Anson, go ahead.
All right, okay. So what you need to do, okay, the first thing what you need to do is you need to actually study, okay, you need to study in terms of specification of the bond, like what's the yield, what's the tenor, all this kind of thing, because all these kind of different terms will definitely affect the pricing of the bonds. So just to let you know, if we are looking at the yield at this moment now, okay, for the first ETBS, the Dana Infra one that is maturing on 2023. So in terms of the duration is left about I would say less than 2 years. Less than 2 years. And the yield that you are getting every year is actually 4%. Okay, it's only 4%. So like the example that I mentioned to you guys previously, okay, if interest rate or the FD rate in Malaysia are going on a upward trends, then do you think 4% is still attractive? Okay, this is the question that you need to ask yourself. Okay, so you will need to know if you committed to buy the bond and hold it for 2 years, definitely you will not you will be getting the yield that you are promised to receive already if the company managed to repay the money, because once the yield are definitely fixed at that sense already. Okay, but if at any time point between you would like to sell the bond, then you will need to depend on the pricing of the bond at that moment. If the interest rate are on an upward trend and the bond price is going down, you may actually suffer a capital depreciation in that sense. Okay, so there are many things that you will need to actually be look at and be aware.
Yeah. I actually just noticed that you're right, Anson. There are only 3 because the third one expired. The third one matured already.
Yeah.
23rd July, okay, matured last month. Okay, so now available ETBS are left with 3, which is 2 are issued by Dana Infra, 1 is by Isan Sukuk. So the yield is 4% plus, and the tenure is 7 to 15 years. Of course, now maybe the remaining tenures, some are less than 2 years. Okay, so you need to be aware. So these are the available ETBS on Bursa Malaysia. So you can, basis on your personal risk appetite to decide which one you want to add in your portfolio. The next question is asked by David Yong. With the QE tapering in the US happening, how would it affect the price of Malaysia bond?
I would say most of the time the direct relationship is not so much here. Okay, but I would say if the tapering, which means the Federal Reserve, they are not printing money or they are not buying bonds at a higher rate that we are seeing previously. Okay, of course it will start to affect the bond price already, especially on the junk bond or some of the investment grade bonds in the US side. Okay, but for local Malaysia bonds, okay, the fund flow will definitely look at our OPR direction. Okay, it will definitely look at our OPR direction, and I would say it's unlikely for Bank Negara to further cut our rate again. All right. So it should be on the higher end already once things start to normalize.
Okay. The next question is, are investors subject to income tax on the interest on bonds?
Yes. Yes. You will still need to actually declare it. Yeah. Actually, for your fixed deposit, you are supposed to declare also.
Oh, this is new to me also.
Yeah, it's
Means
just that many people, they are not doing it.
The interest earned from fixed deposit, we need to declare in income tax.
Yeah.
Oh, okay. Interesting. The next question is, hang on, yeah. Are you aware of the average transaction for ETBS volume?
Average transaction of ETBS.
Yeah.
This one I didn't really go and observe. Yeah.
Okay, no problem. So Saiful asks, are government bonds always lower rate than corporate bonds? Why is it so? How do you measure government bond coupon rate is reasonable?
Okay. I will say most of the time it will be lower. Okay. The key reason is because the financial stability of the government is most of the time you're better from normal commercial companies or corporates. This one is for sure. Okay. So this is a key reason they can actually enjoy a lower rate because you know that their risk profile, their profile is better. They definitely can repay you money. So you are okay to lend to them at a lower rate with the peace of mind. Okay, for most investors, it will be this case. Okay, so the second part of the question is what already? Sorry, Jane.
Oh, how do you measure that the government bond coupon rate is reasonable?
For this one, right? You will need to do relative comparison between bonds already. This is a bit technical. It's a bit technical, whereby previously when I was bond analyst, we will need to actually because for Malaysia governments, okay, I would say easily they will have double digit kind of number of bonds. And so it's quite easy for you to actually find some similar tenor bonds and compare the spread between. Okay, so for example, this bond is having a tenor of about 4.2 years. Okay, 4.2 years bond. The yield is trading at about, for example, 4%. But if you manage to spot a bond that is like 5.3 years, okay, it's only like certainly 1 month or 1 month plus longer, but it's giving you extra like 0.1 or 0.2%, then it would be quite meaningful already. So I should say, you need to do more relative comparison between bonds to see what's the difference. Then you can gauge whether it's reasonable or not.
Okay. The next question is asked by Muhammad Yuharith. I learned that there are bonds with negative yields. Why would investor be interested in it?
Bond with negative yields.
Yeah.
Okay. Actually, for investors that is buying negative yield bonds, those are investors. Okay, whereby in those countries, they are having a negative interest rate environment. So if they don't put the money in the negative yield bond, right? If they put it in the bank, it's likely that the bank will actually charge them more money compared to the negative yield here. So that's why they have no choice and they prefer to put it here, because some of the government, they know, this government I know it definitely won't go for bankrupt one. So I just want to place my money here and enjoy a lower deflation, that kind of depreciation in that sense. This is how it works.
Okay, interesting. Dennis would like to ask, can you tell us about looming sovereign debt crisis where there will be a loss of confidence in developed countries' bonds in the US or Europe due to too much debt, which leads to the bond market to collapse. Do you still remember the Asia bonds or the US bonds?
At this
So do you
sense,
still recommend, not remember, recommend Asia bonds or US bonds? Sorry, eyesight bad.
okay, the question is a bit long. Let me read a bit.
Dennis Lai.
Dennis Lai.
So,
do you still recommend US bond or the Asia bond? I would say at this juncture, personally, I would think that the US bond are better. Personally, I would think that US bonds are better because if you actually look at you actually monitor bond market for the past few months, the Asian bond market actually enjoy a very good rally in terms of the pricing. But at this juncture, the high yield bond space from the Asia bond are actually dominated by news from the China side whereby they want to control many regulations and some of the government-linked entities also, they doesn't want to support them in terms of some of the refinancing. So in terms of the, I would say some of the Asian high yield bond side, they will have some pressure in that sense. So if we are looking at stable bond funds or stable bonds, then I would say you should actually go for investment grade in this sense. Because I guess for the junk bond or the high yield bond funds or the ETF, pricing are already factored in. Yeah, it has priced in what we are looking at for this recovery team really.
So you feel US bond are better lah?
Yes, and I would prefer investment grade bond.
All right, so US investment grade bond. Okay, so what about the looming sovereign debt crisis? That his first question. Do you have any opinion on that?
Loss of confidence in the developed country bonds. Actually, for this one, you will need actually I should actually tell you this may not be the case. This may not be the case because ultimately in the global investment market, bonds are still the largest market. If you compare to equity market, bond market is definitely larger, and investors still need to get diversifications and income distribution from bond investment. So it's just that as a normal individual investor, we may think that things are looking quite bad if we are looking at the debt level of the country and everything. But you need to understand that if the Federal Reserve or the central banks of the European, they can actually keep printing money and the growth are still there, and things may not be that bad as we are looking.
Okay. Anson, are you still there?
Yeah.
Yeah, sorry. Your line wasn't that good a moment ago.
But still can hear just now.
Okay.
Sorry.
Ang Beng Kwan would like to ask the next question, which is, are Malaysia sovereign bonds likely to be downgraded, and would it impact the corporate bonds domestically?
Okay. If you are buying into bond funds, then this is the valid questions that you will need to know. Okay. Sorry, I need to find back the questions again. Okay. So the first thing is whether it's likely to be downgraded. I would say no, because it has been downgraded already. If you actually look at some of the headlines in the past 2 years, the outlook of our country has been put into negative, and our sovereign ratings has been downgraded. Okay, so definitely it will trigger some sell-off. But I would say most of the time when things are getting worse, the instant investor, most of the investor would have already be aware of this already. So in the process, there has been selling, and it won't wait until the moment that the rating agency actually declared that the sovereign ratings has been downgraded, then only they start to sell the bonds. Okay, this is what we need to be aware. And will it impact the corporate bond domestically? Of course, yes. Okay, but I would say at a very minimum level. I would say at a minimum level, because what you need to understand is that corporate and government, the thing is a bit different. The thing is a bit different because the credit risk that we are having from the corporate bonds are stick with the corporate financial profile. Okay, it stick with the issuer itself. And the company, if you are looking at the country and the company, the relationship and the linkage between the country is actually on the interest rate outlook that is linked to the interest rate risk that we are having in investing into bond. So it would be a two different thing here. Yeah.
Okay. All right. The next question is by Woon Kai. Is ETF for bond a good buy?
Is ETF for bond a good buy? I would say if you want to get easy access at a low cost and with a good scale of diversification, ETF is definitely a good buy. But there's a lot of there's many type of ETF you can choose from market. If you go to the Malaysia, the selection is a bit less whereby there's only 3 ETBS in the market. But if you are looking at a market with a lot of selection, you can go to the US market, whereby in the US market, you can actually choose whether you want high yield ETF or junk bond ETF, or you want investment grade ETF or silver ETF also. All these kind of bonds also you can select one, or you want Asian high yield bonds ETF also, you can actually select in different segments.
Okay.
So the key thing is that you need to know which market or which area of bond that you prefer to invest at which point of time, at which juncture. That one is very important.
Paul White would like to ask, do you encourage investment in non-ETBS? If yes, how can we liquidate it in the secondary market in the future?
Okay, non-ETBF, this one you will need to get a dealer to execute the trade for you. Okay, so if you are investing in non-ETBS, which means you're investing it on the OTC market, then normally if you are buying from the banks, then you just go back to the bank's dealer and tell them we want to sell. They will help you to get a quotation. But I would say most of the time, if you want to invest into a bond, you need to at least be okay with holding the bond until its maturity. Okay, because sometimes the interest rate environment may go against you, many things may go against you, and the bond pricing may not be favorable at certain time. Okay, so if you are not okay to hold it, like for example, this bond is a 3 years tenor, you are not okay to hold it for 3 years and getting every year 6%, then I guess you may need to consider on looking at some of comparing at the issuer names in that sense. Because if the issuer is a very famous issuer or famous corporate, then in terms of the liquidity in the market, it will be definitely better one. So in that sense, it will be easier for you to sell the bond in the secondary market in the future. If not, then it will be quite hard.
Usually government bond or corporate bond are more liquid in the OTC market.
It will be definitely government bond. If we are compared, the first thing, definitely government bond will be more liquid. Then the second part, if we are looking at the segment of at the space of the corporate bond, and then definitely investment grade side, it will be more liquid.
Okay, so for those illiquid, not so popular bonds, right? Say a not so popular corporate bond, so there are also chances that we might not be able to sell if you want to, correct?
Yep. In that case, you may need to hold the bond until end of the tenor. Yeah.
Okay. So for liquid bond, because I'm not in the OTC market, so for the liquid bond, right, how long does it take for it to be sold or buy when there's any interest?
I would say be it fast, it can be within few minutes also can be, because most of the dealers in the market, they will be using the Bloomberg terminal. For Malaysia, is like that. You will be using the Bloomberg terminal to actually ask in the market. Okay, so for example, if I'm from Maybank, okay, I will actually use the terminal to actually ask in the market, anyone have inventory for this bond? Okay, they will put the coding, the ISIN coding in the terminal and let them know. So those who have the inventory that is ready to sell, they will just reply back to them. So actually the whole process can be quite fast also.
So usually we buy from another seller, or we buy from the bank?
It can be either way. It can be either way. But if, for example, if bank have the inventory to directly sell to you, then likely the pricing it will be lower. Because if they need to buy the bond from somebody else, other banks or some other sellers, okay, then they will need to pay them at one layer already. So they will try to mark up maybe 0.1, 0.2% on your bond and sell it to you at a higher price.
So that's why you always recommend that we have the mindset to buy the bond until maturity, until the completion of the tenure. So we won't have to frequently trade the bonds.
Yep. Unless you are betting on interest rate changes, then you can actually buy in government bond to bet on it. Yeah.
Okay. The next question is, what happened when the bond default?
Just like my slide just now, okay. It will the first thing they will actually if it's go to default already, it will not straight away go into bankruptcy procedure. Okay, so it will actually try to restructure the company to see whether they will be managed to get a favorable terms. Try to negotiate between the equity holders and bond holders. Try to get some favorable terms from both sides that willing to agree on the restructuring. So if yes, the company can still survive and go on, but in that sense, they will need to restructure the bond. So for example, if they don't have the money to repay you 100% of what you invested right away this year, okay, they may have restructure the bond into a new 5-year bond. Perhaps they will just pay you 50% and the remaining 50%, it will be spread out to a new bond that's maturing in another 5 years time, and you will be getting the remaining 50% of your investment by the end of the 5th year. But you can also sell it in the secondary market. Yeah. So it depends on the restructuring process, whether it can go through or not. If not, totally cannot restructure, then they will just sell off all the asset, and what's the leftover, then they will give it to the bondholder first.
Okay. Let's just do the last question. Beng Kwang would like to ask, can you walk through us about duration and convexity of bonds?
The one is too technical already. I don't think for basic or beginner bond class, we will need to touch on the one, but I can still share with you some of the basic. Okay. So normally, if we are looking at bonds, we will need to know when is it gonna mature. Okay, so the duration is actually quite similar to the tenor of the bonds. Okay, it will be quite similar. Okay, in the layman term, it's quite similar. For example, if the bonds still have 10 years left remaining on the 10 years, okay, so the duration is normally 9 point something. Okay, that is quite close to 10 years on. Okay, it means that for you will, as an investor, you will need to take 9 point something years to actually get back your whole investment, to get back your principal and the coupon. Okay, you need to take this duration to get back your investment. Okay, so as an investor, when we are actually looking at the duration, okay, when we are looking at duration, it means that we want to know, okay, it's quite applicable for bond funds one, because you will actually, if you look at the fund fact sheet, you will actually see that the fund manager will actually show you the average duration of the bond fund is how many percent. Okay, so if, for example, if you see that the bond is having a 10 years duration, or average duration of the bond fund is 10 years, I can tell you the direct relationship you can actually interpret in this way. Okay, can interpret in this way. Every 1% changes in the interest rate, it will translate to a 10% changes in the bond price in the inverse direction. Okay, if the interest rate go down by 1%, a 10 years duration, it means that the bond price will go up by 10. Okay, this is the normal relationship that we will actually use to explain on the duration part. Okay. Yeah.
So I learned that bond investment in bond is better if it's going to be in a declining interest rate environment.
Yeah, just to share with you, personally, so personally, in the previous days, I remember 2 years back when our OPR rate are still at 3.0, 3.25 at that time, right? I actually did speculate on government bonds, whereby I go and buy the longer tenure bonds, like 20 years, 30 years MGS. And once the Bank Negara, they are having that kind of signal, they are signaling the market, hey, I'm actually looking at reducing the interest rate. Okay, so once they move and reduce the interest rate, for example, just a 0.5% interest rate deduction on the OPR, if you're buying and holding a 30 years duration bond, it means that it will be 0.5% times a 30. Okay, so your bond will move in another direction for 15%. So it will be a good way for you to trade and speculate on bonds also. Yeah.
15%.
But you need to have a good macro understanding on the market, I would say, in that sense.
15%, you said?
I actually got 15% within a week.
Wow.
Yeah.
Quite lucrative return for investing in bonds just by half a 50 basis point adjustment in interest rate. Okay. Yeah, thank you so much, Anson, for sharing with us a great deal about bonds. Yeah, I think many of us here have learned a lot more about bonds. Yes or no? Okay, if yes, right, maybe you type 1 in the chat group so we know that you have gained a lot from this session. Okay. Yeah, not only Anson is an expert in bond, but he is also an expert in stock also, okay? All right, so just that today he talks about bond. All right, so thank you so much, Anson, for this very engaging session talking about exchange traded bonds and Sukuk. How can we build a balanced portfolio? So if those of you who have not had bonds in your portfolio, maybe you should consider to have some so that you can stabilize your portfolio return and then make sure that your portfolio can generate consistent return year after year. All right, thank you so much, Anson.
No problem. Thank you, everyone.
Okay, let me tell you more about our next webinar. Okay, but before I talk next webinar, this is Bursa Academy. I think I mentioned many times already, but still I need to talk about this. So it is a comprehensive one-stop e-learning platform that aims to provide investors with a continuous and holistic learning journey. So it's very simplified, user-friendly, and also accessible anywhere, anytime. So just go to www.bursaacademy.bursamarketplace.com. So for our next webinar, it's going to be on this topic, which is 价格行为交易信号. So for this, you know that it will be conducted in Mandarin. So it's happening on next Monday, which is 23rd of August 2021. So 8:30 to 10 o'clock. So I've given you the registration link in the chat group and also in Facebook, sorry, not Facebook, YouTube live chat. So you may register for it if you want to learn how do you find trading timing using price action signal. Okay, for how do you look at price action to determine what when to buy and when to sell. All right, so this is the topic that will be conducted in Mandarin. So thank you so much, Anson, for sharing with us about exchange traded bonds and Sukuk and how do we build a balanced portfolio in it. So yeah, for all of you here who have joined in this session, I hope that you have walked away with enormous value from this webinar. So we'll see you again on next Monday. Bye, everybody.
Bye.
Who is the speaker? The next speaker is Ken Chow, 周国斌老师, for the next webinar.